I think it's got to be earnings front and center. And I think they're probably more important here, Tom, than they have been, given what was a public data drought. And I have to say, technology is leading the charge here with the best revenue growth, some of the best margins in the market, and the best earnings growth. And that's why we're willing to pay a higher multiple for these companies.
Boy, we're paying a higher multiple for these companies, and that's got a lot of people concerned. Do you believe the underlying cash flow and earnings are there to support these valuations?
100%. And so I think investors' wildest hopes and dreams are well placed for those very reasons. It's all about the quality. And we've talked about this before, Tom. I don't think this is an environment where the Bodie Marcus Kane text is really going to help you. This is the Charles Kindleberger text that you've got to dust off.
Right? Explain who Charles Kindleberger is.
So the late famous economist who penned the book Manias, Panics, and Crashes, and I think that this, if we're right, is the mania development stage. That's the part of the framework.
Yeah, but the fear crew, Paul, in the research notes, structural fear, and that crew of legitimate people are worried about the back end of the Charles Kindleberger book.
Which I'm just Googling right now, like the rest of the audience out there.
Yeah.
Talk to us about those earnings. Again, what was your takeaway from this earnings cycle? We're just kind of finishing up here.
So, I mean, it depends on what provider you look at. We look at all of them. FactSet is probably top of mind.
And not here.
Not at Bloomberg, of course. I shouldn't say those things. But we also look at Bloomberg as well. We're loyal followers. And they're coming in better than expected. And I think that speaks to the analyst bar, which is still structurally too low. And so that's why I like to say it's really the fundamental tech dominance that is supporting this market here.
How about this Federal Reserve here? We had a Fed cutting interest rates in the September meeting, but then kind of interjected a little bit of uncertainty into December. Do you care about timing when these rate cuts, or are you happy just to say, I know my Fed is cutting rates, so that timing's not as important to me?
It's a good point. So I am more of a directional guy than a false precisionist. And so I think that's right to expect probably another cut this year. Of the 65% that are in that camp, I would be among them. And I think what's supporting another cut before we close 2025 is the notion that the labor market is weakening here. That's part of the margin story, guys, powering earnings. But also the bond market is telling us the message here, Fed, you got to cut.
How about, are there sectors here that screen well for you guys? Because a lot of stuff's expensive. A lot of stuff is lagged. You know, you look at the 493 names in the S&P 500. There's a lot of laggards there.
Yeah. So generally, we have strategically been of the mind that we'd be shopping the sales in the pro-cyclical economy sensitive areas of the market. And that's the game plan. We're sticking to it. Tech is still at the top of our list, but we also like old economy industrials. Materials, I think, are showing some promise, probably more a 2026 story at this stage, and consumer discretionary.
I want to